going on to the first slide, which talks about the investment strategy and returns and analyst valuations, I think this came out of questions about people wanting to understand our investment strategy more clearly, particularly the exit strategies that we would contemplate. We made very clear that our investment strategy on how we invest, in that we look at the energy metal sector, particularly those metals and minerals that are critical for the energy revolution. And if we look at reports by banks such as Deutsche, etc., and Morningstar, they really clearly identify lithium, rare earth metals, and cobalt as the three sort of most critical elements in that revolution. So we've got exposure to the first two, and we're finalising our due diligence on investing into an early stage cobalt asset. So we look at that. So that is, what sector are we involved in, and then we also look at assets that are not replicable, and that's a strategic term in that they will always have a competitive advantage. And in mineral resource sector, that is always primarily is about having a unique access to a high grade mineral resource. So we're not talking about technical know-how, we're not talking about necessarily IP. We're talking about a license, and having access to licenses that deliver high grade, or by co-products deliver high grade, means that you will be in the lower half, or hopefully in the lower half of the cost curve. And that all being well, we want to be investing in value propositions. So you could have looked at Pilbara a year ago or 6 months ago and said, well, that's a value, that's a great asset. It's going to come to production, and it's coming to production. However, was it a value proposition then? Well, probably not, because it's halved in market cap since then, because people have invested it. So we look to take and find gaps in the knowledge base. So both of our investments in Bacanora and European Metal Holdings are non-traditional, let's call them non-traditional lithium sources, and we use our technical expertise to analyze the mineralogy, analyze the likelihood of so we have likelihood of extraction, so we take a view on the technical risk, and so far today that's worked out really well, with both producing battery grade lithium carbonate and one signing an offtake. And I think that really describes, we then take an active role in management, either on the board or either in the JV or in a management team, so that we can direct and help promote the progress of that company. And that then also comes out to identifying the exit strategy. So at the beginning we have an envisagement of those exit strategies, and that can change over time as the project develops. So we identify and actively promote viable exit strategies as an integral part of our investment evaluation process. And those exit strategies balance the desired return, holding period, and risk. So when you go onto a graph a couple of later on, you'll see what I mean by that. But to have a specific point of an exit strategy on each asset would, one, be something that I wouldn't really disclose straight away, because we are the largest shareholder in some of these companies, and doing so would, by its very nature, preempt selling by the market. So we would do that once we've defined a point in time, which is the risk return has reached a point where we can see that the risk is low enough and there's not to be that much a great return, and look to exit, and that would probably be through a strategic sale. Alternatively, we could also hold out to probably dividend sale. It really depends on the dilution that's going to occur to us along the way, and how is that going to affect us and our returns to us and our shareholders. So I'll go through a bit more about that in the next slide. But first of all, the returns and analyst valuations, I'm always it's for a company to provide a valuation, a price on its own asset, is treading pretty carefully. We have to tread very carefully. So that's why fundamentally analysts review it, and they have an independent view. Even if they are engaged by the company, they have a requirement to be independent. You can see from the returns that we've made, we've got about 95% returns on investment. The equity valuation of our assets at the moment, not including the joint ventures, is about 29 million pounds. And you can see the asset valuation, which is a risk valuation of WH Ireland, Edison and Hannon partners, which basically vary from 0.78 to 0.91. And when people say, well, why are they valuing it on the full NPV and these sort of comments? Well, effectively, the analyst valuation takes builds in, number one, by doing a discount factor. If they're using that, they'll say use 10% or 10 or 8%, depending on the country and basically the weighted average cost of capital. But in addition, they'll apply a risk, what let's call an execution risk. So as the project is earlier in the stage, i.e., let's say it's at the PFS, it may discount that valuation by 50, but depending on the analyst's own metrics, 50 to 75%, so that they can take account for the probability of it being developed. So as these projects develop through the PFS, bankable feasibility study, financing, permitting, commissioning, that discount becomes less and less, and you get closer to the NPV valuations. So when we look at, and going on to the next slide, when we look at those NPV valuations, again, we have our own internal models, but in terms of what we put to the public, we really utilise what there is out there in the public domain, and I've published some of these before anyhow, so let's look at this. These evaluations of unrisked, being aware that this is just the NPV, so this doesn't take any account of any corporate risk or technical risk that they may or may not be in each of these projects. So Bacanora and the Sonora NPV, you can see that the valuations, depending on the cost of production and the revenue per tonne, varies quite dramatically, and this is our interest, our 30% interest in our JV, and our 16% interest in the equity, amalgamating the two and assuming no dilution. So effectively, you could be ended up with between $193 million and $307 million. But, and the reason why I've put that variance is because, the PFS was done in March 2016. Since then, as we all know, lithium carbonate prices have moved up dramatically. They use 6,000. Other PFSs are using 10,000. Some are using 9, and some are using up to 12,000. And we also know, I think it's, I certainly made clear that my view is that some inputs within the world market have gone up. So we would expect to see some increase in cost of production. I would expect overall at Bacanora, just because of some of those inputs now, and that's probably one of the reasons, and definitively why that the bankable feasibility study has been delayed. It was scheduled for release around March, and they're talking end of summer now. But that's been announced ages ago, actually. So that's why there's a variance. So we would hope that let's say using a $9,000 a tonne price of lithium carbonate, we'll get anywhere between 250 and 300 million. The NPV for us on our basis would be there or thereabouts. European Metals, obviously, that's pretty simple. They've done their PFS just recently in March, and they had a project NPV of 540. Our 21% is 108. Yangibana, although they've embarked on a PFS and they are in the process of the BFS. They really haven't defined their pit shells properly. So for us to understand what part of our pit is going to be, what part of our JV is going to be mined, and when in the time it becomes, to put an NPV on it becomes hard. But nonetheless, I'm using WH Ireland's analysis here on an unrisked basis. Be aware of that it could be worth up to 83 million. So if you take all those as a whole on an unrisked basis, i.e. not taking account of corporate risk, you could have valuations which you probably get closer to production, right? Because that's when the risk disappears, of on a cumulative basis somewhere between 450 and 500 million US dollars. So you can see that the potential is certainly there, but there are hurdles on the way. So the difference between the valuations of the unrisked NPV and obviously the pricing that the analysts use, which is a risked version, is considerable. But all things being well, financing occurs. These are the sort of NPV valuations you could expect to see on it, and assuming we retain our stake, the Cadence value would be of those orders of magnitude. So when we look at projects, and so going on to the next slide, and I think people would have seen this beforehand, but it sort of illustrates, we've added some bits and pieces here. There's a typical life cycle of a risk and returns of a mining project. And what we've shown here is the red curve going left to right is the increase in value or increase in share price, increase in value if it's a non-listed asset. The dotted line going from left to right is risk-return trade-off, the risk curve, and that's what we would look. That's where we look at, and then you can see where we would typically invest and where we would exit. So if you look at things like Sonora and Cinnevec, Sonora we invested in late exploration stage, and you can see that was down on the value curve and had improved dramatically. It's in what we will call slightly the doldrums at the moment between, and they're doing Barker the BFS. There's not much news flow, but nonetheless it's a bit like a swan. It's paddling like mad, and a lot of work's going on. And it's, you would see a turn, hopefully see a turn in the valuation of that as it goes past bankable feasibility and into construction commissioning. Cinnevec is starting on its BFS, and Yangibana, as I said, it started on its BFS, although it really hasn't refined itself. It's not as clear a path. And as we said, we look to it enter early. I like Caribib, Lithium, Pilbara. I haven't put everything here, so we can invest smaller amounts and get the largest uplift. And you can see that the risk-return trade-off curve, we would invest in where there's the larger risk, but also the largest return. So from early exploration to PFS, and we mitigate that risk internally by doing a lot of due diligence, spending a lot of time understanding mineralogy, geology, and particularly looking at the likelihood of it going up that value curve. And to date, our investments, our primary investments, and the majority of our capital have shown that that's been achieved. Our exit, as you can see, is assuming that the is successful. We would look from PFS all the way out to production, but you can see that along that line, the risk-return curve flattens out. So the risk is minimised, but also is the return. So, as I said, I'm not going to be specific about each project and when we're going to do it, because there are a lot of moving parts across those projects, and we assess them on a continuous basis and look at their risks, their technical and their corporate risks, and ultimately we want to maximise those returns as quickly as possible, and do the same again. Slide, and I think people would have seen this beforehand, but it sort of illustrates. We've added some bits and pieces here. There's a typical life cycle of a risk and returns of a mining project, and what we've shown here is the red curve going left to right is the increase in value or increase in share price, increase in value if it's a non-listed asset. The dotted line going from left to right is risk-return trade-off, the risk curve, and that's what we would look. That's where we look at, and then you can see where we would typically invest and where we would exit. So if you look at things like Sonora and Cinnevec, Sonora we invested in late exploration stage, and you can see that was down on the value curve and had improved dramatically. It's in what we will call slightly the doldrums at the moment between, and they're doing Barker the BFS. There's not much news flow, but nonetheless it's a bit like a swan. It's paddling like mad, and a lot of work's going on. And it's, you would see a turn, hopefully see a turn in the valuation of that as it goes past bankable feasibility and into construction commissioning. Cinnevec is starting on its BFS, and Yangibana, as I said, it started on its BFS, although it really hasn't refined itself. It's not as clear a path. And as we said, we look to it enter early. I like Caribib, Lithium, Pilbara. I haven't put everything here, so we can invest smaller amounts and get the largest uplift. And you can see that the risk-return trade-off curve, we would invest in where there's the larger risk, but also the largest return. So from early exploration to PFS, and we mitigate that risk internally by doing a lot of due diligence, spending a lot of time understanding mineralogy, geology, and particularly looking at the likelihood of it going up that value curve. And to date, our investments, our primary investments, and the majority of our capital have shown that that's been achieved. Our exit, as you can see, is assuming that the is successful. We would look from PFS all the way out to production, but you can see that along that line, the risk-return curve flattens out. So the risk is minimised, but also is the return. So, as I said, I'm not going to be specific about each project and when we're going to do it, because there are a lot of moving parts across those projects, and we assess them on a continuous basis and look at their risks, their technical and their corporate risks, and ultimately we want to maximise those returns as quickly as possible, and do the same again. We want to be able to take £17 million and deliver it, turn it into circa £30 million, and do that process again over the next 3 years, 30 to 60. And whether that's been retaining our investments in these projects or exiting them and finding a better opportunity to invest again and deliver the same sort of returns in terms of our investment returns, which are around 95% over 3 years. And I think the next slide, which is going on to the next slide, which really I just wanted to show you a bit more about the risk profile. And I think one of the things that I keep on saying is that the technical risk is dissipated in a lot of these. Sonora Lithium and Sinovec, they've processed material, they've proven that they can produce with Sinovec at a lab scale or bench scale battery grade lithium carbonate, and Sonora have put that to a pilot plant, and they produce enough material that they've got an offtake with Hanwha, which is an incredible achievement. Now we go up to the corporate risk, and when I talk about corporate risk, I talk about financing, I talk about permitting, I'm talking about corporate social responsibility, social licenses to operate, land holding, environmental permitting. Those sort of risks start to increase, and execution will start to increase at this point. So there is an important, now our focus certainly for Sonora Lithium and the Bacanora is to understand those corporate risks and how they're being mitigated by the management, and how are they, progressing so far on that. And to date, going on to the next slide, which really I just wanted to show you a bit more about the risk profile. And I think one of the things that I keep on saying is that the technical risk is dissipated in a lot of these. Sonora Lithium and Sinovec, they've processed material, they've proven that they can produce with Sinovec at a lab scale or bench scale battery grade lithium carbonate, and Sonora have put that to a pilot plant, and they produce enough material that they've got an offtake with Hanwha, which is an incredible achievement. Now we go up to the corporate risk, and when I talk about corporate risk, I talk about financing, I talk about permitting, I'm talking about corporate social responsibility, social licenses to operate, land holding, environmental permitting. Those sort of risks start to increase, and execution will start to increase at this point. So there is an important, now our focus certainly for Sonora Lithium and the Bacanora is to understand those corporate risks and how they're being mitigated by the management, and how are they, progressing so far on that. And to date, we've been very happy with what's going on there. So really that really shows, valuations, investment strategies, possible exits that we look at going forward, and really the ambition to take this, again, our investments that we've made and over the same period again, or sort of a 2 to 3 year period, take that investment from a 30 million to a 60 million valuation. That's the idea of and using the model of investment at an early stage, where we can invest small amounts and get the maximum upside to deliver that as our primary model of investment. And so that's where we stand. And so overall, those investments have turned out very well. However, as we all know, and going on to the next slide, the performance, I'm just using here since beginning 2016, of Cadence's market cap relative to its portfolio has been not very good. And there are people have asked for explanations why this is, various conspiracy theories of shorting and all the rest of it, really not viable options there. But the market's thinking, we have to look at how the company's changed over that period of time. So in early 2016, we really just had the Bacanora investment, which has stayed roughly the same in terms of valuation. It's increased slightly, but that was our valuation. So that's what we had. We had a very small part of Synovec, and it certainly wasn't a large part of our portfolio. Yet our market cap was considerably high, 30 to 40 million pounds, 40 million pounds higher than the actual NAV of the asset. Therefore, that valuation must be attributable to the joint ventures, our joint ventures which are not publicly listed in essence. And in particular, I would say that would have been the joint venture with Bacanora on the Sonora Lithium project. Obviously, in March, and where we effectively, and still is confirmed, over half the resource exists in that JV. Although, when we came to March or end of March, early April last year, when they looked at the mine plan, and it was based, was involved with that process, it was based on the best NPV for Bacanora and for its shareholders, and therefore that NPV showed that really Ventana, being the lowest strip ratio, although the grades were similar, that's where the mine would start, and hence from the JV1, i.e. Mexillet, around 17% or thereabouts would be mined from Mexillet, which meant that although half of the resource was going to be mined, was within that area, only 17% would be mined, and it would be mined from year 5. Now that makes a significant difference to the NPV, and I think as that's happened, and this is just me speculating rather than providing solid evidence for the movement in price, we've seen a gradual, a continual move down in price, and we had a peak from the 8th, to the 8th to the 12th of 2016. Well, I'm not sure why that peak occurred. It was probably some speculative aspects there, but fundamentally what we've seen is that as that's come along, we've seen that the market cap has begun to match and starts to be, certainly from the beginning of this year, correlated to the NAV of the assets. And I'll just quickly go on to the next slide, and that just shows us a zoomed in version from the beginning of this year, and you can see that the market cap's gone from about 40 and it's now sitting at about 30 million pounds, and our assets are around the 35 million pounds, and we're at 20-25. So our assets increased by 10 million. We've gone down by 10 million, and I think that's really a reflection here of the net asset value. So when one looks at, we obviously have a convertible loan which comes to fruition in sort of the 8th of September this year, and the market's effectively saying, right, well, let's look at what's got to happen to do that. How is the company going to pay back that loan, which sits around 10 million pounds, and let's net that off its assets. So that's what's happened. The market's reflecting, in essence, the net asset value going forward, and one of the things that we're working on quite actively is to, before that point, certainly before September, is to restructure that loan so that it's more favourable to the company, and we can exit out of this point where we're trading at a discount to the NAV. So that is where we're going to do with that, and fundamentally going forward, where do we see that valuation, and where do we, as I said, it is going to be about the value creation through progress at the project levels, and as they progress up the value chain, we will see them that being reflected in our NAV, and also getting involved maybe in some, which we have certainly with the cobalt in non-public markets. So that becomes a bit harder to value, and it's certainly not a direct correlation. So we can utilise that to promote the stock and move that forward. So in terms of the relative, and I've seen you guys have seen this beforehand, and you look at, and I think this is pretty obvious. Is it's a bit out of date. It's from the I think it's the end of April. Well, just the beginning of April, but it does show that if we take a lithium index, and that's our own created lithium index, including Albemarle and the big ones all the way down to the minnows, a weighted lithium index, of course, and that's performed very well. But obviously, our investment strategy, which is predominantly based around these two assets, has performed exceptionally well and has moved and exceeded that by a wide margin. if we look at EMH's performance, that was probably that period was one of the second or third best performers in the lithium market. So that's really it in terms of what I wanted to address in the slides. I suppose I'll leave it over to Scott to go through any questions or live questions that are occurring. Scott.
Kieran, thank you very much for the presentation that you've done there. It has answered a number of questions that people have submitted there, and there's a lot of questions here. The way I'm going to go through it is by topic, and I will combine some questions that people have sent through to do that. Let's start with maybe a very simple question for you to answer. People have asked, when's the AGM? So Francis and Derek have said, so when is the AGM? Are you able to tell people?
Yeah, the plan is to have the AGM, at the end of July, but at the beginning of August. We are actually in the middle of some engagement with shareholders, and I suppose that's to look at how we structure that AGM and some points about remuneration and placings and as such. So we're in discussions with a group of shareholders to really try and address those issues that that I've seen some questions are, and we'll address that at the AGM. So the most important thing is to get that right, and we will be looking to hold the AGM at the end of July, beginning of August. Of course, the final date will be defined about when we send out our AGM notice.
Now, another element about the board directors is a topic that's there. People are talking about why you guys don't buy more shares in the open market, as it shows confidence that you have in there. Are you able to, so that's PG Williams who's asked that question, and a few other people. What's your response to that?
Well, on a personal basis, obviously I bought, when I joined the company, I bought some 6 million shares, and when I joined the company as CEO, I haven't, as a CEO, before I was a director, and I haven't bought since then. I am also 30-40% down, so it's significant to me in terms of my personal loss there, but I understand the markets and the shareholders' view. Why are we not buying? And on a personal level, because I was involved with Bacanora, I am a director of EMH.
You've done there. It has answered a number of questions that people have submitted there, and there's a lot of questions here. The way I'm going to go through it is by topic, and I will combine some questions that people have sent through to do that. Let's start with maybe a very simple question for you to answer. People have asked, when's the AGM? So Francis and Derek have said, so when is the AGM? Are you able to tell people?
Yeah, the plan is to have the AGM, at the end of July, but at the beginning of August. We are actually in the middle of some engagement with shareholders, and I suppose that's to look at how we structure that AGM and some points about remuneration and placings and as such. So we're in discussions with a group of shareholders to really try and address those issues that that I've seen some questions are, and we'll address that at the AGM. So the most important thing is to get that right, and we will be looking to hold the AGM at the end of July, beginning of August. Of course, the final date will be defined about when we send out our AGM notice.
Now, another element about the board directors is a topic that's there. People are talking about why you guys don't buy more shares in the open market, as it shows confidence that you have in there. Are you able to, so that's PG Williams who's asked that question, and a few other people. What's your response to that?
Well, on a personal basis, obviously I bought, when I joined the company, I bought some 6 million shares, and when I joined the company as CEO, I haven't, as a CEO, before I was a director, and I haven't bought since then. I am also 30-40% down, so it's significant to me in terms of my personal loss there, but I understand the markets and the shareholders' view. Why are we not buying? And on a personal level, because I was involved with Bacanora, I am a director of EMH, and we're consistently, we're consistently inside as a result of various aspects, including the accounts of EMH, the accounts of Cadence, And while I was at Bacanora, obviously their accounts, I was basically always in an inside period. Now there are ways to mitigate that process, and that's one of the things that we're looking at, which effectively divests that purchasing to a third party. Effectively, we appoint, or the board appoints a third party, and we're looking at the cost and the viability of it. Where effectively the board appoints a third party, third party buys on a monthly basis amount of shares. We have no say of how much, just buys a consistent amount. We have no say whether the party should buy it or third. It's almost like an investment trust. So that third party has power to buy that stock, and we would just agree in advance in an open period how much that would be. And we're looking at the viability of that and how one could achieve that. I think that's one of the things that we would like to communicate, once we've gone to the AGM and part of that process. So if we're able to achieve that, that would be great. It'd be great for me. I'd be able to just continually buy, small chunks, but nonetheless just buy over every month over however long I'm employed by the company, it would just be bought by a third party, and it wouldn't matter whether I'm personally inside or not, or the board is inside or not. That third party would not be, and therefore would be able to buy. So we're investigating that and the cost of that in particular, and how that would work structurally. But yeah, so the reality is, for me personally, whether people think the excuse is wearing thin or not, it is I have been inside, and I have the MAR rules to abide by, and there are very few times that I have been outside, and sometimes there's when I'm on a plane or something ridiculous like that. But fundamentally, I've been inside, so I could not buy. So we're trying to work out a way, and I personally want to work out a way that we can do that.
Now, Kieran, another element that, as with any public listed company, is for shareholders, something that they look at with great detail is why you guys don't buy more shares in the open market, as it shows confidence that you have in there. Are you able to, so that's PG Williams who's asked that question, and a few other people. What's your response to that?
Well, on a personal basis, obviously, I bought, when I joined the company, I bought some 6 million shares, and when I joined the company as CEO, I haven't, as a CEO, before I was a director, and I haven't bought since then. I am also 30-40% down, so it's significant to me in terms of my personal loss there, but I understand the markets and the shareholders' view. Why are we not buying? And on a personal level, because I was involved with Bacanora, I am a director of EMH, and we're consistently, we're consistently inside as a result of various aspects, including the accounts of EMH, the accounts of Cadence, and while I was at Bacanora, obviously their accounts, I was basically always in an inside period. Now there are ways to mitigate that process, and that's one of the things that we're looking at, which effectively divests that purchasing to a third party. Effectively, we appoint, or the board appoints a third party, and we're looking at the cost and the viability of it. Where effectively the board appoints a third party, third party buys on a monthly basis amount of shares. We have no say of how much, just buys a consistent amount. We have no say whether the party should buy it or third. It's almost like an investment trust. So that third party has power to buy that stock, and we would just agree in advance in an open period how much that would be. And we're looking at the viability of that and how one could achieve that. I think that's one of the things that we would like to communicate, once we've gone to the AGM and part of that process. So if we're able to achieve that, that would be great. It'd be great for me. I'd be able to just continually buy, small chunks, but nonetheless just buy over every month over however long I'm employed by the company, it would just be bought by a third party, and it wouldn't matter whether I'm personally inside or not, or the board is inside or not. That third party would not be, and therefore would be able to buy. So we're investigating that and the cost of that in particular, and how that would work structurally. But yeah, so the reality is, it for me personally, whether people think the excuse is wearing thin or not, it is I have been inside and I have the MAR rules to abide by, and there are very few times that I have been outside, and sometimes there's when I'm on a plane or something ridiculous like that, but fundamentally I've been inside, so I could not buy. So we're trying to work out a way, and I personally want to work out a way that we can do that.
Now, Kieran, another element that, as with any public listed company, is for shareholders something that they look at with great detail is the remuneration of the board. What are your response to people talking about your remuneration, and is it justified?
Well, there are two aspects to remuneration. There is, let's call the fixed salary, and there's remuneration or parts of remuneration which link to performance or performance of the share prices, investments or targets within the company. So let's look at the fixed remuneration. As we outlined in our annual report, the salaries of the overall of the board of directors is in the lower quartile or below the median of a company of this market capitalisation, and that's taken from the CGI review. So we're certainly below the median, and personally, from the year to this year, I took almost almost a 38 or 40% pay cut, and that was just a reflection of where we were. We looked at what we were doing and how we were doing it, and we reviewed our salaries. And some people went up. I think Andrew's salary went up because he was being active and more involved. Mine was okay. Well, let's try and keep our costs down. And overall, if we exclude the non-cash element, the board remuneration has dropped by about 11%, and we are well below the median, and in some cases in the lower quartile of remuneration, of fixed remuneration. In terms of, let's call it performance-related remuneration and so on and so forth, we have, I think there was some options awarded at the tail end of, beginning of July last year. And again, as I said, we're in discussions with shareholders of how we should change that, and I'm very much in favour. I was an independent director of a FTSE main board listed company, and I'm in favour of introducing corporate governance code rules within Cadence, and so we're looking at this will be part of the AGM, where we will be putting in any remuneration in terms of performance-related remuneration would have a direct link for shareholder approval. So, the shareholders can make that call then and then, and it's up to the shareholders to. So, particularly in relation to options or equity, that would require shareholder approval to approve the plan. And if we perform, then we would get it. But if we don't, we don't. I think it's going to be aligned to the performance of the shares and the performance of the equity of the company.
Now, Kieran, with regards to Iskander and the interest that they took within the company, a few people have asked you to maybe expand a little bit more on that and maybe why they didn't take a larger interest.
Well, they took a convertible loan note, and they had some issues in relation to getting Mexican clearance. So, in fact, at the end of the day, as we announced on the 30th of September, that in fact a proportion of that convertible loan note ended up with American investors and European investors. Well, actually, mostly American institutions. So, actually, Iskander are not a material aspect of that loan note, and we have several Hong Kong, one Hong Kong institution and several and a US institution, both of which represent over 75% of the loan note. And those that were converted, that wasn't Iskander, that was some other institutions. And as far as I'm aware, when I look at the register, they were long gone out of the register, within a few days of them converting. So, Iskander still hold their stake, but it's not a major stake. and they haven't converted, so they haven't sold any.
So, with regards to future fundraise, is any plans for further fundraising, and how are you planning to do that, if so?
So, I think I highlighted in an IGTV interview. Look, all being as is, so no further investments for cash. We would not require to raise any capital in terms of equity capital. Obviously, we have 8th of September, we have a convertible loan note that will mature. So as I said, we're working on about actually 4 strategies at the moment in which how would this exercise. We would possibly pay part in cash and convert some of those shares. But at the moment, we're still reviewing those possibilities. But that's nothing that no one knows about anyway, because obviously that disapplication of those preemption rights was applied in July last year. So in terms of new capital for running costs, no. In terms of if there was a bull terrier of an asset that came along that we just thought, wow, this is the best thing since sliced bread, which we haven't got one on the table at the moment in terms of new assets. We would, and we had to raise cash. We would look to raise equity, but again, reviewing the process of what's happening, we would look to do something which is we've talked to our solicitors of what we will call a open offer. This would allow private shareholders to participate. How would I'd keep that under review because of the experience so far. New capital for running costs, no. In terms of if there was a bull terrier of an asset that came along that we just thought, wow, this is the best thing since sliced bread, which we haven't got one on the table at the moment in terms of new assets. We would, and we had to raise cash. We would look to raise equity, but again, reviewing the process of what's happening, we would look to do something which is we've talked to our solicitors of what we will call a open offer. This would allow private shareholders to participate. How would I'd keep that under review because of the experience so far and our lawyers' experience for those open offers is that often they cost more. They cost about 200, let's call it £100,000. They cost more than is actually raised. So, and he's experienced about 7 to 10 of those. But we would definitely look at putting that in place and see how it performs. If we see that it's a value creation, it doesn't cost the shareholder money to do it, then we would continue to do it. That's a plan that we would look to implement as well.
Now, Kieran, a number of questions have come about prior to your presentation around your investment strategy. I think you've really covered a lot of it within the presentation today. But one question from Sammy: what's the strategy in place for the next 5 years during the lifespan of projects? And a lot of people are talking about exit. Just reiterate those elements for us. But exit is a very important element for people.
And it's absolutely important for us because there's no point in having these lovely returns without crystallising those returns at one point in time, or better returns at one point in time. So it's absolutely vital for what we are about. So in terms of, I think people talk about various timelines, 1 to 5 years. Well, look, in terms of the strategy of the investments, I think the individual subsidiary company or individual investments have outlined how they're going to develop it. And I think in my graph, I showed the typical development timelines so that we know that Bacanora is going to be finished its bankable feasibility around September. We know that it's got an 18-month to 2-year build period. And that's including financing, so that we know that where we're going to, well, they said 18 months, so we know where we're going to hit out in the production level. And the company's judgment, Cadence's judgment is with regards to EMH, well, that has always been, and I've consistently said, it's about a year behind Bacanora, so we would see that 1 year later. So off the top of my head, I think Bacanora is around 2019, so you'd expect production from EMH, all being well, given those corporate risks, around 2020. So that shows us, and then the first, year or so, there'll be a lot of them paying back their debt, and then eventually there would be dividend streams from that, one would assume. So we've either got to wait fundamentally, if we looked at that risk return curve, to that point where we would start to see dividend streams, and of course, if the view, good corporate views are that if there are no better investments to make that would deliver returns of that sort of level, you would look to return that dividend flow in part to shareholders. Obviously, between now and then, as I said, we consistently review exit strategies, and if there are opportunities on the way when we assess the return, i.e. our return to our shareholders, not the NPV of the project, the return to shareholders as a result of a possible dilution by equity raising by the companies that we're involved in, what effect debt is going to happen, what is the debt equity split, etc., which really is in certain lithium is a harder estimate because it's not a commodity. We look at those and say, well, actually, we've sourced this possible strategic exit here, and that strategic exit is going to be better than the risk return that we would get on a dividend stream later on, given the corporate execution risks, etc. And of course, we review it on a technical basis. So if we see any red flags that we feel, which there are none, we would also look to exit then. So it really it's on a case-by-case exit, but we would look to exit in the broader sense, between the PFS level and all the way just up to production.
So you also covered
BFS level, just starting at BFS level.
Yeah. So, Kieran, you also, a lot of elements about the investment valuation, you cover that in great detail. So I'm going to move on from that into the slightly prickly element of share price. If I could just sort of read you out just a couple of questions from people. So Simon says, what do the board think that has been the cause of the poor price performance in the last few months? And then I've got another one from Paul. How can it be that profits have increased more than tenfold since 2015, but the share price is lower than it is then? And what needs to happen for the share price to start performing? And it's a message from a lot of people. How does the share price start to perform? And that's a big question for everybody.
Well, I think as I sort of I explained I certainly looked at 2016, but the story would have been similar back to 2015, where we saw that as a result of whether that be speculation or the market perception of what we were, we've seen a narrowing between the value of our joint ventures and etc., particularly our joint ventures, and the NAV. And I think the market has really just taken to us and said, right, we are an NAV-based company. So they look at our market, the market cap and our market interests. Now, so they say, well, you've got 20% of this and 20% of that, just add them together and we end up with a price. So, that has probably been one of the drivers between where we were even a year ago or a year and a half ago and now. And I explained that there was a substantial premium. I explained that the possible reasoning for that, given where the resource was on the JV, and how that's changed, and how the model, how the mining model at Bacanora has changed. Rightly so, because it's the right thing for the shareholders, and we are one of those shareholders. So that's narrowed. And what are the critical points of how that's going to improve? Now, I'm at pain to forecast prices because, one can never forecast the market. But all I can say is, and look at the avenue to production, and how historically within other projects, if they are successful along those targets and milestones, i.e. getting to bankable feasibility study, completing that, getting financed, commissioning and production, looking at that curve of valuation, which is a generalist curve, you will see, one would expect to see, if all those things being successful, an incremental increase in the value of our underlying assets, and therefore in the value of our share price and our NAV. So that's what we have at the moment. So we have those two assets that were embarking on that process. And as we outlined beforehand, analysts have said, let's call it 0.7 to 0.9 on a risked basis. That's where they put their valuation. And on an unrisked basis, if we look at the NPVs, that's around 400, 450 to 500. So those sort of values you would sort of expect to achieve, all things being equal, around closer to production. So I can't forecast that the price will directly correlate to that, but evidence and history has shown that it does correlate to that. That's why that graph is fairly well known, produced by Smith et al. So we would hope to see, with that progress of those assets, an increase in the share price. However, what we also want to see, is looking at our junior assets and helping them progress and trying to replicate exactly what's happened with something like EMH and Bacanora. Although they are earlier in the stage than those both were, but they still have we believe that they have that potential, otherwise we wouldn't invest in them. So we would look to get those assets up that curve and accrue value to us as a result of that, and their valuations to go up, and therefore have a reflection in the NAV. Cadence's interest. He's there to represent the interest of all shareholders. So fundamentally, within Bacanora, there is this issue where effectively we have a joint venture and a shareholding in the company. Now, the interest of the joint venture may, of course, be at odds with the interest of the company. Case in point, the whole, the development of the mine plan. So with the resources on equally, roughly 50-50, not quite 50-50, but on both of those assets. The best for the company, i.e. Bacanora, is to develop it in the way that they put their mine plan. However, of course, the best for the joint venture is not to develop that down and develop our JV. So there's a conflict there, which, given my technical background and understanding, it was often, effectively I was prevented from entering into discussions on behalf of Cadence to discuss that JV, because I effectively would be conflicting. I would be arguing against the interests of Bacanora shareholders. So in the end, and where we were and how far they progressed, we reviewed our position there and we looked at, okay, where can and how can I serve Cadence's shareholders best? And in essence, when we look at it and the amount that I'm involved, I serve Cadence's shareholders best by being off the Bacanora board and being solely focused on Cadence's shareholders' interests, which include the JV and include our shareholding. I fundamentally believe that the development plan is correct and it's the right thing, because the majority of our value lies within the Ventana pit, because we have 16% of that indirectly, and that's where the most value is created. However, there are aspects of the JV that we need to negotiate and move through, and I can do that better. Well, I can do it, otherwise no one else could. I can do that sitting on the board of Cadence without having the potential conflicts and issues that revolve around being on the board of BCM. On top of that, that has allowed me to spend far more time on Cadence, because it's not just, as a non-executive director, it's not just simply sitting there and twiddling your thumbs and reading board papers. As I said, we take an active approach. So I was, relative active, whether that be helping delineate resources in the early stages, working with SRK, and helping Peter out on the resource side and geology side. We were involved. Now our involvement is more about the JV and how we progress that and maximise the value for us on that front.
So how's the relationship there, Kieran, now that you're not on the board? Is it still good?
Yeah, I think obviously there was a tricky time, and there was that offer period that was I think difficult between both parties. But even through that, Peter and I discussed and talked to what we could, and kept a very open relationship as much as we could. And now I believe that the relationship is better than before. It's certainly much more professional, and I'm I think it's that cathartic process has resulted in a tighter knit shareholder to company relationship, and it's working very well.
Now, Kieran, We've had a couple of questions, one from PG Williams, another one from Derek Bennett, casting the doubt over being able to obtain lithium from clay. What are you able to tell people about that?
Yeah, and I think this is generally a process, and it's in particular actually Hannam & Partners mentioned it as a potential risk. And of course Hannam & Partners haven't been out to site. Hannam & Partners haven't viewed the process. Hannam & Partners haven't gone out there 5 times, or 2 times in the last year and reviewed that process. So, we're confident that process works. We know it works, and clearly, if it didn't, there wouldn't be a offtake with Hanwha. The process of getting that out, at a pilot scale, and I talk about it's a fairly large pilot scale. When you scale up from a lab to pilot, that you have some risk. There will, of course, there's always a risk from scaling up from pilot to a large plant, but that risk exists with everything. That risk exists with spodumene. There are spodumene plants in Australia which are having issues of delivering grade. Orocobre had issues with delivering battery grade. In fact, they're selling technical grade. But those risks exist across the whole lithium sector. So we understand this process, we understand those risks, and we know how Bacanora have mitigated those, and we've been confident in this process. Otherwise we wouldn't have reinvested since they announced that they had produced battery grade carbonate, and lo and behold, that's come to fruition, and they have entered into an offtake with Hanwha and produced enough samples. And it's not just producing, a 50 gram sample. We're talking about 70 to 100 kilos of samples that Hanwha will then, or an offtaker will then distribute to various end users, because Hanwha are trading house. The end unit on a sort of no names basis, the end users will say if this product is viable for their batteries, and will, I assume, test it and run it through the produce a cathode out of it, and ensure that it's going to make a good cathode. So I think, although people have a risk because it's an unknown, no one's produced from it, the evidence to date shows that it's viable and an offtake is there. So, having a confidence offtake is the ultimate stamp of approval at this stage. Ultimately, it will be about constructing a plant and producing battery grade on a consistent basis when you get to full production. But as far as it goes right now, this is the best confidence you can get, and that's getting the offtake in place.
Now, Kieran, I've got a message, question from Gary James. Has Tesla still got an option to finance the Bacanora mine?
No, that agreement, in essence, I have to be very careful because we're still partly bound by some of those, the way that we talk about it. But fundamentally, and I think I let our analysts talk about it, and the analyst said, look, that agreement is no longer in place. So because basically there was a precondition to finance, and that was not achieved for various reasons. Nothing to do necessarily with anything to do with the project itself, but really about the pricing methodology within the contract. So when we because it was below market, right? It says it was below market. So when we looked at it and you were going to do funding, people weren't really willing to fund it below market. So fundamentally, it wasn't financed at those terms, and we continued to have discussions on how to change those, and fortunately, nothing was reached. So we then moved forward, and I think the greatest thing about that allowed Bacanora to open its doors and get involved with people that are going to pay market prices rather than a discounted market. So although it was a great name, fundamentally it's much better for Bacanora to be where it is now than it would have been to be in that contract.
So a question from Sean: when do we expect authoritative approval from the Megalith concession and transfer of it into the Megalith holding company, clarifying our 30% interest?
Authorities, and we are continuing to push that. So it is relying on the Mexican authorities of approval. We're getting more and more information, but fundamentally what we have also looked at is reviewing the geological data that we've had to date and narrowing the license areas, because to continue I mean, one of the things that it not being formally transferred means that we've not had to pay any license fees, which is great when you're talking about, you know, in excess of 100,000 hectares of land. Those license fees can be quite considerable, and you know, I'm not talking, you know, I'm talking in the 200 to 300,000 pounds sort of region. So we've not had to pay them. So actually, we're looking at this and going, well, you know, reviewing it as a whole. We're taking our external review of it as well, because obviously work has already been done. We're now taking an external review by an independent party to see if there are any further targets. If there are no further targets within that megalith area, we'll narrow it around the areas that we know are targets and focus our exploration there. And I think one of the issues with the Mexican authorities, it was such a large concession that they were that we were blocking out such large areas of land, and that seems to be one of their issues. So I think in the end we will make it down. And then from that, I think that would we believe the Mexican authorities would have no issues with just getting it all approved and done.
Kieran, one of the questions that's coming through in the live questions at the moment about Bacanora is about the potential takeover. So Gary, Robert, Ian, Derek have all sort of submitted questions around the attempted takeover of Bacanora, and was that something that was that a sensible element to try and pursue?
I think I have to. Well, first of all, I wasn't involved in that, as you can understand, because I was on the Bacanora board and I was on the Cadence board. So I was kept out of it. In fact, was really only informed of it happened when the Bacanora board knew. That's how it works, because otherwise I can't be. I would never have been involved in any unilateral discussions in that regard, because I would be in breach of both contracts one way or another, and you know, it's just not the right thing to do, and it puts me in incredible level of conflict. So I can only look at it with retrospect and hindsight after a period of time, and I would say that it was a sensible theory in terms of, you know, amalgamating these assets. However, I think maybe the pricing needed to be higher or something in that regard. But I think really, and it didn't turn out to be such a, you know, it ended up in a public spat, which wasn't ideal, and maybe should have been dealt with slightly different. But fundamentally, the idea of having these entities, when you have a JV in particular, although the JV is not large, was a sensible thought process. But we've moved on from that now, and I think, as I said earlier, we're actually closer as a result. We're working better on the JV. We're working better as a shareholder, and very clear role defined that we are a shareholder and we have a JV, and we work with Bacanora, and we're supportive of what they're doing, because although their price has stayed relatively static, fundamentally they have progressed this asset well.
Well, as people say, hindsight is a wonderful thing, Kieran, and we would all love to have that crystal ball. Now, moving on to Yangibana, when will Cadence be required to, what are the potential costs to Cadence for the BFS and the DFS?
Well, the potential costs are, in pretty simple terms, it depends that they haven't specified how much their DFS will their DFS will cost. They haven't outlined that or communicated what it's going to be as yet. But if we, there is a rule of thumb, and the rule of thumb is effectively it's the DFS or a DFS will cost between 2 and 5% of the total capital required for the project. So in the case of, let's say this project is $500 million of overall capital, you're talking about a $10 million requirement on the DFS. Now, and I'm being vague out because we don't know what the pit plan is going to look like, but even if all of the mine was based on our area, that would be around a $3 million requirement. But the likelihood it isn't. If you look at where they're developing pits and where the resources are, it's going to be a fraction of that. As yet,
our requirement to do it is once they call on us to do so, and they commit, and that has not happened. So we have a not contributory. So we're free carry as far as I'm concerned at this moment in time. And the worst that could happen is if we decided not to contribute based on our risk return. We do have a net smelter royalty return in that contract as well, so it would convert to a net smelter royalty return, so which is non-contributory. So we still have a limited downside on that Yangibana stuff. So at the moment, we haven't been called, we haven't contributed. We're in conversation with Hastings about when that should occur. And they're saying not yet.
So moving on to Greenland, can you tell us a little bit what the plans for Greenland licence areas are? And that's from Sean.
Yeah, so at the end of last year, our financial year rather, we said that we'd be reviewing those Greenland licences and the long term, what we would be doing with those licences. In essence, we've got fairly large licence packages in the region of that would represent on an ongoing cost basis, if we're not doing any exploration out there, 200, £100,000 a year in terms of holding costs. So what we've been doing is re-reviewing the data that we have, targeting areas on rare earth elements and where they're going to be, and holding on to those licenses that will be, we believe, of value. Fundamentally, we have to look at Greenland energy. So if GGG develops its asset, that is the takeoff, because that is one of the largest rare earth deposits in the world, and we're not going to have something of that quantum because it's fairly very unique, the Cacornite deposit there. We've got Cacornite dikes at smaller scales, so we would wait, fundamentally, those will get developed and mined once GGG really develops that area and puts the port and the infrastructure. And off the top of my head, there was a capex of I think it was about 1.5 billion that would need to be done there. So we would hold the ones that are important to us after, and those that just have nothing on them after doing all our work, we'll just we'll dispose of them, because there's no value in holding them.
So, Kieran, I've got another question from Samuel. When are production of lithium and other minerals like cobalt, nickel, etc. commence at 7 sites?
Nickel will be amazing because we don't actually have a nickel deposit, I say, and cobalt we're still finalising the due diligence. So that's early stage exploration. That's a long way away, and if we look at and it's dependent on lots of successes. So those ones, they're early stage. But I think what people are really focusing on is from the various sites, in particular the Bacanora, which is the most advanced Sonora lithium project, and the MH. When are those going to come into production? When are we going to see dividend streams or such from it? Well, Bacanora have highlighted clearly where their plan is. They're going to complete their bankable feasibility study by the end of summer. They're going to embark on an 18-month process of construction, which that process includes financing, I assume, within that. Then after construction, they haven't highlighted this, but you typically have depending on your commissioning, 3 to 4 month commissioning, and then you'll end up in a production phase. Now, that production phase is not an immediate production, right, I'm doing to 17,500 tonnes. There's a slow ramp up. And that ramp up, depending on how successful, bad or good they are, was 3 to 6 months. So you will see a slow ramp up of production during that period. So that takes us out, off the top of my head, out to 2019, the tail end of the tail end of 2019, really, when we would start to see the commissioning process, and early 2020, but let's say to end of 2019. What I would say on, and that's obviously contingent of all those, those risks being in place. So, financing in particular, permitting, etc., etc. So, looking at that risk curve, those are the risks that the project would be exposed to then. And on EMH, the Sinnovec one, well, as I've said beforehand, they're about a year behind. So they haven't highlighted, they haven't put out clearly what they're going to be doing and when they're going to exactly be in production, but I would call them a year behind, given where they are now. So you'd see a year later that they would come in. We would anticipate that they would come into production, but we need to let EMH determine that and put that out in the wider world. So yeah, but both projects are going really well, and we're very pleased with them. So on lithium, that's what you're going to see. The other ones are, they're early stage, and I wouldn't want to be putting timelines until we start defining resources and economic assessments, i.e. scoping studies and PFSs around them.
Thank you. I've had a question from both Steve and Gary. Is David Lenegas still involved in the company?
David isn't. He resigned as a director. Was it a year and a half? When was it? 2 years ago. 2 years ago. It's a while ago now. So he resigned as the director of the company. We have a relationship with him because I know him, and so sometimes projects come across his desk, and we review them independently and assess whether we're going to invest in them. So so he's a great source of new ideas in terms of project flow, and certainly that's what we've invested in some of those projects.
So we've covered a lot of different elements, Kieran. Maybe a final question from Edward Green. Cadence portfolio has been growing nicely. It's a diverse geographical spread, but does the board have a vision for their complete target portfolio? Would you like to see, and how close are we to that at present?
Okay, so portfolios by any means should change. To have a target portfolio, I think in terms of specific assets, I think that's a dangerous place to go, because that then locks you into an asset, whether it performs well, badly, or there's an issue with technical issue, or you feel that you need to exit it before it's released at the risk return ratios that you want. But in terms of in terms of assets, I think in terms of a target, so it's two things. There is, are we exposed to the critical metals across the board, and are we exposed to enough assets, or the right amount of assets along the development curve? Well, I think if you looked at where we were, and in terms of those assets that we have, there is a gap where we haven't got any advanced exploration work there. It's all. I would be reluctant to invest at this moment in that middle area, because they're being valued as if they're already a bankable feasibility study, which then takes out any upside for us. Maybe I'm conservative valuations. I should just go with the herd, but and it will all turn out well. But I stick to these fundamental drivers, which are really important to us. So in terms of that, there is a gap, but at the moment there isn't anything right at this moment sitting on our desk that fits that gap in terms of valuation. There are ones that have great KPIs in terms of great access to assets, infrastructure, but the valuation, the value proposition is not there. When I look at exposure to the type of asset, i.e. we've got obviously lithium. That's where, or if you look at our portfolio, that's where all of it really is. We've got both BC and EMH making up the bulk of 27 million. But if we look at potential, we've just been exposed to cobalt, and we will be looking in other areas within that cobalt sector. So we've got exposure to rare earth minerals through Yangibana. We've got lithium exposure, so we just need a bit of exposure in cobalt, and we're actively looking at assets. Again, we're finding because of the valuations, they're ending up on the early exploration stage. So we have to do a lot more work in terms of due diligence, because there's far more risk there. So in simple, I don't believe in a static portfolio. But if we were to look right now, and that portfolio should change as we capitalise and exit and reinvest in better positions, I would be reluctant to invest at this moment in that middle area, because they're being valued as if they're already a bankable feasibility study, which then takes out any. So in simple, I don't believe in a static portfolio.
But if we were to look right now, and that portfolio should change as we capitalise and exit and reinvest, if there's nothing to reinvest in, fundamentally, the obligation is to return some of that capital to shareholders. But there are opportunities there still. But I would say those opportunities are in the early exploration stage rather than in the advanced exploration stage, because those valuations are quite hefty. So I would want to probably maybe look at another cobalt asset, and we have several, reviewing, but they're so early stage in terms of what we're doing at the moment. It's nothing that is sort of price sensitive, as it were. So that's it's. I think needs to have a bit more of a critical metals, and we need to push those into the advanced exploration stage so that we fill that gap in terms of development timeline.
Well, Kieran, we've covered a lot of different topics today. First of all, I'd like to thank yourself, and I'd also like to thank all the people who have submitted questions today. Obviously, it was difficult to answer each individual question that came through, but I hope we gave a good overview of the different questions that came through today. So, Kieran, thank you for your time. Thank you for the people who have submitted the questions.
No, thank you, Scott, and thanks for everyone who took the time out to talk to me, or listen to me rather, for an hour.